Hi, Thomas Brinsko here, publisher of BIC Magazine and BICmagazine.com. I had an opportunity this week to hear a presentation from the American Chemistry Council's chief economist, Martha Gilchrist Moore, regarding the outlook of the U.S. economy in general, but the chemical markets in particular. Bottom line is they predict a short and shallow recession, but they're still hoping for a soft landing for the economy. The three main themes of the presentation around the chemical industry centered around number one, short-term headwinds, which include weak demand for goods. Number two, a longer-term boost from government spending, including the bipartisan infrastructure deal of 2021, the CHIPS Act in 22, and the more recent Inflation Recovery Act. And the third theme was tremendous uncertainty about the future and concern about regulatory overreach. It's no secret that 2023 has been a difficult year for chemical manufacturing, as most of the end-use industries that use chemical products have experienced a downturn. The weakness in the U.S. chemical market emerged in the third quarter of 2022 and accelerated right into the end of last year. These end-use markets that are down include everything from textile, mill products, paper, plastic products, construction industry, petroleum refineries, and even the computer manufacturers had a difficult year. Production outages due to weather events didn't help either. The American Chemistry Council expects a decline in both basic chemicals and agricultural chemicals for 23 and a modest recovery in 2024. Now, I'll take any and all growth, but the recovery in 2024 looks to be driven by capacity expansions in manufacturing driven by government spending through the legislative acts that I just mentioned. These are the net zero and low carbon projects, of course. And I just don't believe that an economy based on government-directed spending is going to be sustainable. On a positive note, the American Chemistry Council projects that U.S. petrochemicals will remain competitive versus international competitors due to feedstock prices. You may know already that as a rule of thumb, when the oil to natural gas price ratio is above 7, it advantages the United States over its international competitors, as our plants use natural gas as their feedstock and theirs tend to use naphtha. But what I found most interesting in the presentation were the challenges and sentiment as expressed by the manufacturers surveyed by the American Chemical Council. 89% of respondents predicted weaker sales for their products to U.S. consumers, while 76% were worried about attracting and retaining a quality workforce. And the theme of tremendous uncertainty going into the second half of 23 and 2024 was centered around regulatory overreach. That fear is not unfounded. The current administration is seemingly always imposing by regulation what they can't seem to pass through Congress. You probably didn't notice that the last Friday of July, they always seem to drop bad news on a Friday to avoid press coverage. The administration proposed a 236-page revision to NEPA guidelines. Now, NEPA is the National Environmental Policy Act. These guidelines are going to require federal agencies to consider climate change and environmental justice in their project reviews. As reported in the Wall Street Journal, as proposed, if a company wants to build a gas pipeline, agencies might have to evaluate if a solar plant would better promote environmental justice, however the regulators decide to define environmental justice. Now, NEPA was enacted in 1970, so Congress should be able to amend it, but this administration is just going to change the guidance on how to enforce it. This act was intended to protect local environments, but the administration now redefines environment to include the purported global effects of climate change. This revision declares, quote, leases for oil and gas extraction or natural gas pipelines that have local effects, but also have reasonably foreseeable global, indirect, and cumulative effects related to GHG emissions. Really. The administration also quietly settled a lawsuit with the Sierra Club by agreeing to remove 11 million acres in the Gulf of Mexico from future oil and gas development to protect the Rice's whale. The settlement will also restrict transit for oil and gas vessels, but no other ships through a long strip of land where the rice whales haven't even been found. This kind of collusion between the government and this private group is called sue and settle. It's another way the administration can strive towards its idea of a green agenda and bypass the lawmaking process. This regulatory overreach and explosive government spending hasn't gone unnoticed by the major credit ranking agencies either. Last week, Uncle Sam's credit score dipped for the first time in a decade. Fitch downgraded the country's rating from AAA to AA+. Treasury Secretary Yellen called the downgrade flawed and puzzling. In explaining the decision, though, Fitch said, quote, "The rating downgrade of the United States reflects the expected physical deterioration over the next 3 years, high and growing general government debt burden, and the erosion of governance." Standard & Poor's is another one of those credit agencies. It dropped its AAA from the United States back in 2011. Back then, the ratio of debt to GDP in the United States was about 65%. Today, the Congressional Budget Office expects it to be 98% this year, 98.2 actually. It's expected to rise to 115% of GDP next year on the present government trend. The reason U.S. debt hasn't been downgraded earlier and more often is because the dollar remains the world's reserve currency, but that can vanish in a flash. This is where political leadership matters and where it has failed. The American energy and manufacturing industries and the U.S. credit ranking services are both concerned about the political overreach. There's a reason why the downgrade happened under this watch. We're blessed with a resilient economy, then we need leaders who will support it or at least get out the way. If you're not following BIC Magazine already on Facebook or LinkedIn, I wish you would. If you have any questions or like to give us a call, please do. God bless.